Hi, my name is Steve Walker from Promise Money and welcome to this really exciting and actually massive announcement with regards to Help to Buy. Now, you're likely to know what Help to Buy is because that's the government scheme that helps people get onto the housing ladder, but it's got a big problem with it. The problem with it is it only applies to new properties. Okay, now the reason this announcement is massive is because there's a new scheme that's come out which means that it's available on second-hand properties. So I'm going to tell you all about that. But first, before I go on, do remember to subscribe to our YouTube channels because there's going to be more to come on this in due course. So I'm going to be telling you more about this soon. But this is a quick fly-through overview of this new Help to Buy product which is just hitting the market and we are piloting for the lender right now. Okay, so just to be clear, this is not the government-backed Help to Buy scheme which is restricted to new build properties. It's an independent product which can be used to purchase previously owned property. Now that means this gives borrowers access to far more properties to buy, up to 95% of the purchase price. Okay, there are many more second-hand properties out there on the market than there are new ones. And that means that many borrowers may qualify for a loan with this scheme when they don't qualify for a normal 95% mortgage. And overall, it could even be cheaper than a 95% mortgage because of the blended rates, and I'll talk about that in a moment. And the other important factor is the loan repayments are interest only, which also helps reduce the monthly cost for people who are struggling to get onto the property ladder. Okay, the information on this Help to Buy loan is not exhaustive, but it's correct as of right now. That's why you need to subscribe to our channels because you'll get further updates as and when. Now, let me tell you how the second-hand property Help to Buy loan works. Borrowers only need a 5% deposit and can borrow up to a further 25% towards the purchase price by way of a secured loan. Therefore, they can take out a 70% loan-to-value mortgage at a far lower rate instead of a 95% mortgage, which is currently and normally at a far higher rate. So, what are the benefits of this? Well, firstly, more borrowers may qualify. Where a traditional first mortgage lender is limited on the amount that they can lend because of the applicant's income, borrowers may be able to borrow more with this new product, potentially up to 6 times their gross income, whereas most traditional mortgage lenders are capped at 4 to 4.5 times gross income when lending at a high LTV. So, first point, you might be able to borrow more. Secondly, it could be cheaper. If you take out a 70% loan-to-value mortgage and a Help to Buy loan which takes you up to 95% mortgage, the rates on the 70% mortgage will be lower than if you had taken out a 95% mortgage. So the lower rate on the mortgage plus the loan could work out cheaper overall and a lower rate overall than the 95% mortgage. Now that's where an advisor comes in because they're going to do those comparisons for you. So it's important that you use an advisor. Now the other important factor is that the loan is on an interest-only basis. And that's important because that helps reduce the monthly repayments at a time where a lot of borrowers are getting onto the property ladder. Cost is everything. Now, there is something to be aware about interest only. So whilst it costs you less because you are just paying back the interest and not the capital, it does mean that the balance on the loan is not reducing. So there does need to be a strategy in place to repay the mortgage, such as a remortgage or a sale of a property or a pension or cash ISA at some point in the future. So there has to be a strategy, and again, a broker will help you with that. Another point, and this really is important, you can now buy second-hand properties using this Help to Buy scheme. So think of the government scheme and how that's helped so many people. But that's only for new build properties. This is for second-hand properties and there's loads of them out there. But why second-hand property? Well, why is that important? Well, the reason that's important is that with the second-hand property, you are getting access to a property which potentially you can improve. Therefore, potentially there's more profit in it. Whereas a new build, there's not much you can do to it. And in fact, with new build properties, a lot of them are sold at a premium, so they go down before they go up. So not only does buying second-hand property make more sense because there's more choice, it makes sense because you can buy a fixer-upper. You can buy something that you've got profit built into it from day one because you're going to do some work to it. You don't get that very often with new builds. So remember, this is a loan equity share scheme, which means that the lender shares in any increase or decrease in the property value. Okay, so if the property goes up, the lender shares in that, but if the property goes down, the lender takes a hit too. Getting advice is really, really important on any Help to Buy loan. It should be looked at as just a tool really to help you meet your requirements. So your mortgage broker will look at all of the 95% mortgages that are there, and will also look at this product alongside it. They'll compare the two and they'll be able to advise you which is suitable. It's a complex job for an advisor to do as there are so many variables. However, that's their problem, not yours, to be fair. You just need to make sure that any advisor you talk to has access to this product as well as the whole of the market. And at the time of publishing this and giving this video, this product is only available to a handful of specialist companies like Promise Money. In fact, we're rolling this out on the trial. There's been some PR out there within the trade, but really this product is only coming to the market now through Promise and a handful of others. So let me talk you through some of the features. First of all, let's talk about rates. So the interest rates on the loan element are fixed for the first 5 years on an interest-only basis. The actual rate is dependent on the loan amount, so you need to speak to your advisor to get the up-to-date rates at the time. But there are no early repayment charges. So remember, this is an equity share loan, and so you need to be thinking about, whilst there's no early repayment charges, there is a cost because if the property goes up in value, the lender shares in that, and I'll talk about that in a moment. And the other factor is that you can make overpayments on this loan. Now let's talk about the criteria. Who will they lend to and who won't they lend to? The property being purchased must be occupied by the owners as their residence, so it's not available on buy-to-let properties. Okay. Borrowers must pass the lender's affordability and credit checks. Now I did say earlier on that you could borrow up to 6 times gross income. On a mortgage, you're going to be capped. This loan allows you to burst that and borrow a higher amount. So that's really important too. But you do have to pass the lender's affordability and credit checks. Applicants must have a 3-year address history. Foreign nationals must prove evidence of permanent rights to reside in the UK. And the borrower, you potentially, or if you're a broker, your client, the borrowers must contribute at least 5% of the property value as a deposit. There's a minimum household income for all applicants of £25,000, but the good news is both employed and self-employed applicants are accepted. Let's talk about property type now. These loans are available in England and Wales. It's not in Scotland yet, and there may be some postcode restrictions for places which are out of the ordinary. The property cannot be a new build, it cannot be a buy-to-let, it cannot be a council right to buy, it cannot be an HMO, a house of multiple occupancy, and it cannot be an ex-local authority flat or flats above commercial or shared ownership properties. So it's aimed at your bog standard house. The minimum property value is £100,000, the maximum property value is £1 million. Above £1 million can be considered on referral. Let's remember, this is a new lender, they're just coming to market, so I think they're going to be sticking pretty much to their criteria. Freehold flats are not accepted, but that's pretty standard across all or most mortgage lenders. And leasehold properties must have a minimum of 35 years unexpired at the end of the mortgage term you're taking out. Okay, credit history. So as the lenders are lending to a high LTV, they're looking for borrowers with a pretty good credit history. What does pretty good credit history mean? No unsatisfied CCJs greater than £250 or so, and no CCJs arising in the past 12 months. No unsatisfied defaults, no defaults arising in the last 12 months of more than, say, £500, and no bankruptcy or IVA in the last 6 years, and no payday loans taken out in the last 12 months. But I've got to just put a reminder in here. Remember, this is this lender's criteria for doing the top-up loan. At the same time as this, you're taking out a mortgage. So we've also got to make sure, or your advisor has got to make sure, that the mortgage you take out, you meet their criteria as well. And that's an important factor. So we're blending two products and bringing them together, just like the existing Help to Buy loan. Age, this is a product which is great for young people. The maximum age at the end of the loan is 70, and the minimum age at the start of the loan is 25. So if you're 24. So if you're 24 and over, you can apply for this loan. And the maximum repayment term of the loan is 40 years. you don't need to take it for 40 years. It's interest only, so it's not going to alter how much you pay each month. So again, and something else to discuss with an advisor. Now, there are other criteria to be aware of, such as where does the deposit come from and things like that. So let me talk briefly about gifted deposits, because for a lot of young people, the bank of mum and dad often helps out. So gifted deposits are acceptable if they come from a close family member. Overseas deposits, well, those are considered on referral, but lenders look at those pretty hard, because if the money's coming into the UK, they need to understand where it's coming from, and they need to fulfil their obligations with regards to anti-money laundering. So they will consider that, but it's looked at a little bit harder. And purchasing under value is acceptable as well. So if you're buying from a close relative, or maybe you're a tenant right now and you're buying from your landlord and therefore you're buying at a discount, those are scenarios that can be looked at for you. So let's just go through a few quick questions and examples to maybe help you get your head around this product a little bit further. So the mortgage you take out alongside this Help to Buy equity loan must have a loan to value of 70% or higher. And it must be a repayment mortgage, not an interest only mortgage. Just as a reminder, this loan is an interest only loan, which means you're paying back interest every month. Your monthly payments do not pay off any of the loan itself, any of the capital. So the balance is not going to go down, but you can choose to pay off extra if you wish. So when you come to repaying your equity loan in part or in full, the amount you pay is worked out as the balance you are seeking to repay plus a share of the increase or decrease in the property value. Let me explain that with a few numbers. So let's make an assumption that the value of the property at the start of the loan is £200,000, and the amount of the equity loan that you took out and was granted by the lender was £30,000. So that's 15% of the property value. Okay, your equity loan represents 15% of the property value. If the value of the property increases by, let's say, £10,000 during the term, the total amount to be repaid by you to the equity lender if you were to sell the property or remortgage would be the £30,000 you borrowed, obviously, plus £1,500. And the £1,500 comes from 15% of the 10% growth. So the property's gone up by 10%. You've got a 15% equity loan, so the lender shares proportionately in the growth of the property. Okay, get that? Now, if the value of the property decreases by £10,000 during the term, the total amount you'd be paid would be obviously the £30,000 in full, less £1,500, because the property's gone down by 10%, therefore you pay the lender back less. Okay, so they take the hit. They take the hit if the property does go down in value. So as a reminder, you can repay the loan whenever you want. There are no early repayment charges on the product. You can pay it back at any point during the term of the loan based on the valuation by a qualified surveyor to determine the valuation of the equity share. So if you say, I want to remortgage and pay back the equity share, I'm not selling, then a surveyor would be appointed who would determine the valuation and then determine what proportion of that the lender would take based on the equity share that you took out in the first place. So the outstanding balance will be reduced by the proportion of the loan you pay off. For example, if you wanted to repay 20% of the total amount owed, then you'll pay the lender 20% of the amount they lent you, plus a corresponding share of 20% of the increase or decrease in the property value. The good news about this is, if you're watching this video, all of this is on our website, so you can read through this and get your head around it, because it's difficult to follow if you're just listening to what I'm saying. So, as a couple of other key points, with this scheme, you retain 100% of the property. It is your property, and therefore you're responsible for all the costs, including and not limited to your first charge mortgage payments, the repayments on the loan, any improvements or repairs, any surveyor's costs, estate agent fees, building insurance, water, electricity, just like you would on a normal house. It's your house. But I think this scheme is fabulous, and just to recap, it's going to allow people to get onto the property ladder who previously couldn't, but access to second-hand properties which have more inbuilt profit in them, where there's more choice, So it should really make things a lot easier. And as I mentioned earlier, there are a number of benefits that you might find that this loan makes it more affordable than a traditional 95% mortgage. It might cost less. So there's all sorts of reasons why, if you're now looking to get onto the property ladder, you've been thinking about Help to Buy, you've been thinking about new builds, now think about the second-hand market and get in touch. Okay, there's more information on our website, and there'll be links underneath here. So that's promisemoney.co.uk. Look in the mortgage menu and in the guide, you'll find information there on the government Help to Buy scheme as well, and alternative schemes such as Right to Buy, shared ownership, to get you on the property ladder. But for now, take a good look at this product, and please do subscribe to our YouTube channel, which you'll find links to underneath this video or around this video. And I could point here, who knows where they could be. Have a look and do subscribe. I hope that wasn't too much all in one go. My name's Steve Walker, Promise Money, and we look forward to being of service to you at some point in the future. Thanks a lot. Bye bye.